Is Verizon a value trap? Today's episode, we are going to understand the answer to this question. We're going to understand, is a dividend cut imminent for Verizon? It currently offers a yield of 8.51%. Or to the contrary, are we looking at an incredibly cheap price for Verizon where we can expect to see our yield on cost over time going to double digits, 12, 13, 14%? And is this really incredibly undervalued? In today's episode, we're going to take a look at the historical performance of Verizon Communications. We're going to look at their performance as a business, their revenue growth year on year, as well as their essential bottom line net income. We're going to take a look at the health check of the company, comparing their total cash versus total debt. We're going to take a look at their year-to-date and 5-year performance in total return versus their competitors. And we're going to take a look and see what are institutions doing with Verizon. Are they adding or are they selling shares of the company? This is going to lead us nicely to that all-important dividend safety, as well as some dividend metrics and financial metrics you need to understand before taking a position in Verizon Communications. And as always, we will run it through our valuation model, getting to our intrinsic value and our acceptable buy price given that margin of safety. Now, as I've mentioned, it has been hammered down 22% year to date, right there towards the 52-week low. However, it does offer a yield of 8.51%, and we want to understand, is this essentially a dividend trap, or are we looking at an incredibly cheap price where we can expect to see 50 to 100% upside to Verizon over the next few years, and therefore seeing that yield on cost in double digits? So, in terms of their revenues, we like to see 3 to 7% growth year on year. December 2018, 131 billion reported on the top line. 5 years later, their latest annual report, December 22, 137 billion. So they have had an increase on their top line over the last 5 years. Not that much though in real terms, and we'll look at the percentage wise shortly. And on a more granular level, we do see the inconsistencies with a growth from 2018 to 19 before a decrease and then an increase and another smaller increase. So some slight inconsistencies on the top line and not massive amounts of growth. Does the bottom line tell a different story? Well, net income, bottom line 15.5 billion reported in December 2018. Latest annual report, December 22, 21 billion. So some nice movement in that growth of the bottom line over time. But again, on a more granular level, we see an increase from 18 to 19 before a decrease and then an increase and another small decrease. So again, some inconsistencies in reality in terms of the income statement. But then moving on to essentially their balance sheet and taking a quick health check, we look at their total cash versus total debt. So they held around 2.75 billion in December 2018. And their latest quarterly report showing cash of 4.9 billion. So just under double growth of their cash. How does that compare numerically and directionally to their total debt? Well, total debt, as we can see here, December 2018, 114 billion, which is a large amount considering their cash position. And then their latest quarterly report, a huge 182 billion. So they are sitting on a massive amount of total debt, and this will in turn affect that all-important dividend safety score that we will discuss shortly with some very important metrics. And then how does that essentially compare in terms of real return, total return, including dividends reinvested, to their competitors? We have Deutsche Telekom, AT&T, and a few others that you may have heard of. Well, year-to-date return, the sector as a whole hasn't performed that well, but what we can see, Verizon has been one of the worst performing in the industry with a return of negative 16%. The best performing, however, SCMWY at 14% return, still slightly underperforming the S&P 500, but performing far better than their competitors. Well, how does this in reality compare to the 5 years? So over the last 5 years, real term, how has Verizon performed? Well, not great at all, in all honesty. The worst performing, minus 25%, and that is with those dividends reinvested. So the question is this something that will be repeated in the future? But as I always say, we never look at past performance as an indicator for future performance, but it's good to include as part of your review or analysis of stocks. So what are the institutions doing? Well, straight away, institutions hold around 61% of the company in shares. And in terms of buying and selling, well, the last 12 months, they have sold 10.76 billion worth of shares. But interestingly, they have bought more, which at 22.21 billion, showing that institutions are buying more shares in Verizon than they are selling. It's always good to take a look at this, but don't bear any essential buying or selling decisions on what institutions are doing, and always do your own research. So now jumping onto that all-important dividend safety score that we see here at 70, making it safe. It is a market cap of 131 billion, making it a mega cap company. Now, in terms of the recession, if people are believing a recession is near, we have some recession metrics here. Last recession, 07-09, Verizon did in fact increase their dividend. Recession sales, relatively flat, negative 1% sales, but bear in mind this was above the average growth of companies in the S&P 500, which was negative to a larger degree. And we can see it did outperform the S&P 500 with a return of negative 38 versus negative 55. Very poor nonetheless, but again, we can see it did outperform the S&P 500. So something to digest on investors who believe a recession is looming. Now, dividend growth, they have been paying increasing dividend growth streaks for the last 16 years. Bear in mind the last increase, which came last month, was 1.9%. Last 5 years, 2%. Last 3 years, last 20 years, 3%. Now, why do I absolutely hate all of these percentages? Well, always salary, dividends, other income producing assets, you need a minimum of 4% or more. The reason for this, the US inflation rate over the last 40 years was 4%. If you are getting less than that, you are losing essentially your purchasing power and in effect taking a pay cut. You could argue though a 1.9% increase is okay given the high yield at 8.5%, but personally I would be liking to see at least a minimum of 4%. Now, dividend yield theory states that the company is undervalued when the current yield at 8.51 is above the 5-year average of 4.49. So we have our first sign of undervaluation. Bear in mind, we never look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. And also note that this is the highest the yield has been over the last 5 years. Likewise, forward PE sitting at 6.8 versus the 5-year average of 11.1, another sign of undervaluation. Likewise, sitting below the sector PE of 15.9. Now, as I mentioned at the beginning of the episode, it's right there at the 52-week low, but do note 52-week low does not mean undervaluation. Likewise, 52-week high does not mean overvaluation. Earnings versus free cash flow. Now, this is going to be a great example why I tell viewers to ignore earnings where it is susceptible to manipulation by management through accounting and to focus on free cash flow payout. Now, the reason for this, as I mentioned, it is susceptible to manipulation. And what we can see, if you looked at 2022, you would be very happy below 70%, although my preference is 60%, as it means, in my opinion, management do have capacity to offer those double-digit dividend increases we love to see. But 50%, if you look to the free cash flow, 104%. Now, why do I call this a big red flag indicator? What this is signaling is that in 2022, so last year, Verizon paid out more in dividends than they generated in free cash flow. This is a red flag and it will inevitably affect that dividend safety score with a dividend cut possible if it continues to be paying out more than they are generating. So bear that in mind. However, we can see in 2023 it is expected to come down to 64%, but do see the same thing happen in 2016 and 2017, whereas if you look at the earnings, you wouldn't really understand that full picture there. Likewise, earnings per share data is available there for investors who like to look at that, but I'll draw your attention to free cash flow per share. $8.29 in 2013, $2.48 in 2022. Now, this is the opposite of any graph that you want to look at. It's going in the wrong direction, and you can see, in fact, the real inconsistencies. 2013 to 2016, it was decreasing before going up to 2020, before in 2021 seeing that negative cash flow 683. Now, the positive to note from this is that in 2023, it is expected to be 419, but still it isn't going in the right direction that we do really like to see. And then we move on to sales growth. Now, yes, 3 to 7% is what we love to see at a minimum, in fact, and it has hit that nearly every single year, but we do see years 2016 and 2020 with negative growth. So real terms, what are we looking at? 121 billion on the top line in 2013, 137 billion in 2022. Not really a fast-growing company, which isn't what you'd expect, but also do note if it isn't hitting an increase of 4% every single year, it isn't hitting inflation at a minimum. So in reality, some years it is essentially decreasing in real terms. So then moving on to shares outstanding. Yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets, but do note from 2013 to 14, they issued shares, so diluted your position as a shareholder. Although they do that in very small amounts year on year, it still does affect your position. And as I mentioned, if they've done it once before, which they did a very large issuance in 2013 to 14, they are fairly likely to do it again in times of need. Now, ROIC, it is one of my 7 golden dividend metrics. Do check the pinned YouTube video to see the other 6. I like 10% plus. Reason for this, it means management are able to effectively allocate their capital. Now, whilst it has been at 10% or more year on year, interestingly, from 2015, it has started to come down nearly a few percentage points year on year. So I would say just keep an eye on that. But as long as they can maintain 10%, for me, management isn't really an issue. Operating margin, nice to see above 14% consistently as well from 2015 onwards. So that is very positive to see. Free cash flow margin, again, very inconsistent. Some years above 7%, some years below, and in fact negative. So something just to keep an eye on moving forwards. Now, probably one of the best metrics to look at for a telecoms communications company that has a lot of debt, the net debt to earnings for interest, tax, depreciation, and amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. 3.5 being essentially the maximum we would like to see. Now, whilst it has been below that every single year, it has crept up quite high. We can see 3.37 in 2022. Now, it is roughly expected to be that in 2023. But again, if it does continue to increase over that line, that will essentially affect that all-important dividend safety score. But so far, there's no real worries, but something to keep an eye on. And on the right, purely showing us the percentage of a company's financing from debt as opposed to equity. Now, as always, if you do enjoy the content, value is being provided. Hit that like button, hit the subscribe. It really helps the community grow and shows me that these videos are really helpful. And as always, if you want to grab a copy of the valuation model to get your own intrinsic value and your own acceptable buy price for companies in your portfolio, do click on the pinned comment below. Now, jumping into the first valuation, the Graham's valuation, we have a Verizon, stock ticker VZ, earnings per share, growth rate per analyst estimates with that yield on AAA corporate bonds. As we can see, giving an intrinsic value of $33. When we take a look, it's slightly higher than the current trading price, between 5 to 10% upside, and within that 52-week range, still showing signs of some undervaluation currently. And bear in mind, when you lock in that yield of 8.51%, over time that yield on cost with share price should increase. Now, as always though, do bear in mind we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. Second model, multiples valuation model. We really only have one similar comparable company, so 2 reasons why we will exclude the multiples valuation model. One, there's only one company to compare it to. I like to have at least a minimum of 2, ideally 3 or 4. And the second reason, given the negative earnings per share, it won't essentially come out to a positive calculation. So therefore, this model will be excluded. However, typically we just get companies in a similar sector and size, get the average P multiple and multiply that by the earnings per share of the company we're analyzing. So the second model we're using, the dividend discount model, where we see the yearly dividends year on year. Average 1.84% forward looking. I've gone for 1%, slightly lower than the average. I do believe this is on the more conservative side, but as always, if you want to play around with the percentages, depending on your own estimates and values, you can grab a copy of the model and run through your estimates. So this gives a DDM price of $38, some nice upside to the current trading price, still within the 52-week price range, but again showing signs of undervaluation in the current market. We then move on to the discounted cash flow model, where we have our free cash flows year on year. Average growth rate just shy of 15%, forward-looking analysts estimating 6%. With that discount rate, we get the present value of future free cash flows and terminal value, add the cash, subtract total debt, and arrive at the equity value. Divide that by the shares outstanding gives a DCF price of $39. Again, some nice upside to the current trading price, around 30%, slightly lower than that 52-week high, but again, as we saw earlier, signs of undervaluation in the current market. Now, essentially, the intrinsic value is the average of the 3 models that we have just run through. And again, if you do enjoy the content, value is being provided, smash the like button. It lets me know you enjoy these videos and helps get this out to a larger community. And as always, do hit that bell button and subscribe if you want to be continually notified of these videos. So the current price around $31.25, typically margin of safety, 10% I would say, wide moat, strong financial metrics, good forward-looking data. That would mean a buy up to $33. If you're looking for a 15% margin of safety, it would essentially be the current trading price now. Personally, I would say you need a minimum of 20% for a company like Verizon. So you should be looking for a buy around $29. As we can see, that's still slightly lower than the 52-week low. Reasons for this, there are a lot of essential issues that I do see with the company. We do see that total debt ever increasing, which does cause some strain on that dividend. We did see some years essentially where the dividend or the payout is over the amount of free cash flow generated by the company, and you do have competitors, new competitors in fact, coming into the market. Possibly there was talk of Amazon a few months ago, and there is also that Starlink, which can be seen to have issues with Verizon moving forwards. But again, for me, that would just increase my margin of safety. Wall Street do forecast the price over the next 12 months to hit around $39.45, higher than our intrinsic value. So they do believe there to be some nice upside to the current trading price. As always, let me know your thoughts in the comments below. Are you looking to add Verizon, sell, or purely on the sidelines speculating? As always, though, have a great day. Don't forget to like and subscribe if you haven't already. Grab a copy of the model if you want to below. And as always, we'd love to see you over on our Patreon in the Discord. So do click on the below comment where we talk about all things finance and stock market related. Have a great day. Catch you on the next episode and take care.